All right, welcome everyone. Thanks so much for joining us today. This is investing in fix and flip properties with your self-directed IRA or 401k. My name is Sean McKay, and this is an American IRA presentation. And so today's kind of an interesting topic in that there's a lot of content out there on YouTube, on different stations about kind of turning really ugly houses into pretty desirable places to live in with interesting finishes. And so that I think intrigues a certain portion of people and gets their wheels turning about how real estate can be a profitable venture. And so while those shows are kind of aesthetically interesting to watch, what you find is that the people that are the most financially successful with the fix and flip strategy tend to focus much more on the meat and potatoes, the financials behind the real estate deals, and not so much on spending days or weeks trying to find the perfect, shade of paint or whatever the case may be for the kitchen. So today we're going to get deep into the idea of what this looks like from a financial standpoint and how some investors tend to make these types of investments with their IRAs and 401ks. And so today is obviously a discussion on self-directed retirement accounts. And so American IRA is one of the very few self-directed providers that is fully integrated. So we have the same ownership group for the administration company, which is American IRA. That's who you interact with, as we do for our parent company, which is New Vision Trust Company. That's our custodian. And that's really beneficial for you as the client for a few reasons. The first is the flow of information is phenomenal. Because we're fully integrated, we have daily conversations with our fellow team members on the New Vision Trust side. So we're getting the most up-to-date, real-time information from the auditors, from regulators in terms of what they want to see documentation wise, what are red flags in our industry in terms of asset classes, whatever the case may be, we get that stuff in real time. The second component is because we're fully integrated, we're able to be incredibly cost effective with our overhead and the way that we're structured, which means that we have the lowest fees that you're going to see in the industry. And so as you can see from this chart, historically, you're going to find that in the self-directed arena, your annual fee is either going to be based on the size of your account. And so as your account balance grows, so does your annual fee, or it's the number of assets, which is typically about $300 per year per asset. So for us at American IRA, we've looked at this structure and we've said, quite frankly, it's not really fair to be making more money each year as our clients do a better and better job investing their money and growing their portfolio. We're providing a service of essentially the bookkeeping and the reporting to the IRS each year, which is the same thing that every self-directed provider can offer you. And so our premise is we shouldn't get to see the upside just because your account balance grows. So that's why our annual fee for our IRA product is simply $285 a year. So as you can see from this chart, that becomes an enormous savings on an annual basis as your account balance grows. This will ultimately end up saving you thousands of dollars a year. So it's great to have really strong fees, but you also want to make sure that you're not compromising on the service that you're getting. And we're really proud of the way that our team services these accounts. Regardless of the online platform that you look at, we are incredibly highly rated by any review company, if you will, that's out there, whether it's Better Business Bureau, Google reviews, Yelp, et cetera, et cetera. We're extremely highly rated on all of those platforms. So you're getting really the best of all worlds. You're getting incredible fees and incredible service. Now, as we discuss today the idea of fix and flips, keep in mind that any real estate concept can be purchased by your self-directed retirement account. So it can be anything from raw land to condos, townhouses, single family houses, big commercial buildings, industrial complexes. And so what we'll discuss today is kind of the meat and potato, the bread and butter type of single family house that an investor might want to fix and flip. But we've also seen investors that will fix and flip commercial shopping centers. So they'll kind of repurpose a big old building and then they'll go and sell it to some other investor that's going to just turn that into maybe a triple net lease property or find some sort of profitable use for that. And so that can also be done as well. So the scale can be whatever you desire and whatever your skill sets allow you to do. And really, as we like to say, as long as it's not collectibles or life insurance policies, you can largely make those investments with your self-directed account. And so when we look at fix and flips, there's a few things we want to have clarity on as we're looking at potential investments. I've been very fortunate to be around some really sharp real estate investors in the 20 years that I've been investing in real estate. And frankly, anything that I say of any value, I'm just copy and pasting from somebody who's much more successful. And I'm just following the leaders, if you will. And so one of the best pieces of advice that I ever got was from one of my mentors, Coach Carson. Uh, he has a YouTube channel, Coach Carson. His name's Chad Carson. And he talks a lot about when you're just getting into real estate, you want to create an avatar for kind of the ideal type of property that you're going to want to invest in. So that as you're looking at all these different types of deals, you're not just caught up in the emotion of just exuberance in one day and saying, yeah, I'm going to buy a property today. And whatever comes across your desk, you're doing it. You have clarity of mission, you have clarity of the area, the type of property, et cetera. And so I think that's a really great exercise, especially for those of you just getting into real estate. So the first concept would be looking at the area. And so typically areas are graded from an A to a D scale, A's being the very best, D's being the most challenging areas. And there's certainly pros and cons to everything from the A's to the B's to the C's to the D's. What I will tell you is that the D properties tend to be where the newer investors tend to gravitate towards because they're less intimidating, because they're lower price point houses. The challenge with D properties, especially if you're doing a fix and flip model, is ultimately you need to find a buyer for this property. And it can be challenging to find a buyer in a very undesirable part of town. And so you want to be very careful with making sure you fully understand the neighborhood and the part of town that you're investing in, so that you're not trapped with a property that you thought you were going to make significant money on, only to find out that in fact it's very difficult to find someone who wants to buy that property that can also qualify for a loan. Then conversely, on the other end of the spectrum with the A properties, certainly a lot of people want to own the best properties in the best parts of town, but certainly they're the most expensive properties. And so if there's a changing real estate market, as some of the metropolitan areas are going through, it can be a little bit more difficult to get a $4 or $6 million house sold versus a $400,000 or $500,000 house sold. So there's definitely variables that we want to consider when we're looking at the area. The same is true for the type of construction that you're looking at. So I boil this down into two very kind of general categories of cookie cutter neighborhoods and older neighborhoods where maybe the properties were built 50, 60, 70 years ago. And again, there's no right or wrong. There's pros and cons to everything. The cookie cutter neighborhoods, I find that they're easier for us to comp as an investor. So we understand what the value of the property is because the houses in the neighborhood are very similar in nature. It's kind of a planned community. There might be only 4 or 5 different types of houses or models of the houses in that neighborhood. And so you essentially know what the value of the property is in a certain condition, which also means you have to be very careful how you buy those properties, right? So if you know it's a $300,000 neighborhood and you buy the property for $270,000 and you're planning on putting $40,000 into it and selling it for 400, that could be very difficult to accomplish. So you got to be very aware of those comps. And the same can also be true with the older properties in the older neighborhoods. You might find that one side of a street has very different values than the other side of the street, because the other side of the street might back up to a park, and maybe in that park in the evenings there's crime and there's things going on, so it's actually considered to be a far less desirable part of the neighborhood to live in. So there's all sorts of nuance associated with the urban or older communities, just understanding exactly what's going on there. And so as we dig down deeper into a fix and flip concept, it's really important to understand the value and how we can understand and run the numbers on a fix and flip deal. And so when we want to understand the value of a property we're looking at, it's super critical that we're solely focusing on the sold comps relative to this property. It's truly irrelevant what people are putting the houses in that neighborhood on the market for. Again, this could be a $300,000 neighborhood, and you look at the neighbor who's just put their house on the market for 400,000. You say, wow, that means my house has to be worth around 400,000. They can ask for 400K all they want. Highly unlikely that they're going to get that sort of a premium for their house relative to the other properties in the neighborhood that have actually sold. So we're focusing just on the solds, and we want to have the most recent comps that are as similar as humanly possible to the property that we're looking at. So especially in a transitioning market, which some of the metropolitan areas in the country are kind of transitioning, they're maybe softening a little bit at this point. We want to ideally get comps from the last month or so, but definitely no further out than 6 months. We want to have as close to the same square footage, bedrooms, bathrooms, size of garages. So is it a 1-car garage, a 2-car garage? Do they have a garage? All these things are really, really critical, because the sold comp that sold for 300,000 but has a 2-car garage and has an extra 500 square feet is a very different product for a homeowner than your property that does not have a garage and is 500 square feet less. So we want to be as close as humanly possible. For me, I've always been of the mindset that, frankly, I'm not the brightest crayon in the box. And so I want to be in my own backyard so I can take as many of the variables out of play as humanly possible. So I want to have the ability to not only look online at the comps, I want to be able to drive those comps and see what's happening in that part of the neighborhood. Because what you might find is that there's a dog of a comp that makes you second guess the value of your property. But as you drive by, you realize that homeowner unfortunately bought a house next door to really what looks like a junkyard. They got all sorts of trash and vehicles all over the front yard, and they got 6 pit bulls tied up on chains and this, that, and the other thing. And that's a very, very different feel to that street than one that's kind of better maintained and just doesn't seem to have any kind of unusual characteristics from the outside. So you really want to drive those comps so you can get as good of a feel as humanly possible. So anytime you go to a boot camp, I don't even know if boot camps are really in vogue anymore, but back in the day, when I was in college getting started in real estate, they had a lot of boot camps where you'd pay usually a couple $1,000s to spend a weekend with someone who is an expert on a specific real estate strategy. And so I went to one for essentially learning how to do fix and flips. And what they spoke a lot about was the MAO, the maximum allowable offer that you can make on a property. So the concept here is that you start with running the comps for what this property will be worth when it's completely fixed up and you're ready to sell that property. So it's all spiffed up, you've done all the work, mission accomplished, everything is done. So if we start with the premise of a retail value of 200,000, and then we discount 30%, which ultimately is going to factor in the financing costs as well as our profits. So in this case, the discounted amount gives us an amount of 140K. So that's 60,000 is the cost of funds as well as our net profit. So let's say that the cost of funds for borrowing the money with the interest that you pay, et cetera, is going to be, let's say, $10,000. And so at the end of the day, you're going to spend another, between the purchase and the sale closing, another $5,000-$10,000, depending upon whether there's realtors or not. So you're going to have a remaining balance of profit there. You're going to subtract out your repairs. So you have retail of 200K, discounting 30% for financing, closing costs, and your profit. Your repairs are 40,000. What this means is that using this formula, the most that you could offer a homeowner or an owner of a property that's listed through a realtor on this property is $100,000. Now, normally when people see this type of structure, they think to themselves, I will never be able to do a real estate deal because there's no homeowner in the world that would agree to sell their $200,000 house for $100,000. But what you have to understand is, first of all, it is not currently a $200,000 house because it needs $40,000 in repairs. So even though the cost of materials and labor has gone up, that means that there's still some real substantial elements that need to be dealt with this property. It could need a new HVAC, new roof, maybe some cosmetics inside. It's not looking like a $200,000 house. Also, what you're going to hear a lot from educators in the real estate space is that you're in the business of solving people's problems. You're in the business of helping someone who's either behind on being able to pay their mortgage, or somebody who's just lost their job, or divorce, or death in the family, whatever the case may be. You're buying an asset that for whatever reason they can no longer afford or they do not want. And so thousands, if not millions of investors will tell you these deals happen. Regardless of where we are in the market cycle, you can buy properties at a substantial discount to what their ultimate retail value is worth. So this is just an exercise. It's a formula that if it's new to you, you might want to take some notes on it. Retail, subtract your profit margin, your repairs, and then you're left with a maximum allowable offer. So if the most you can pay is 100, many investors will obviously start lower than that, 80, 90K, whatever the case may be, and see where they land on that. So as far as acquisition strategies go, and just the concept of the flow of the money, keep in mind that the retirement account is actually going to be the owner of the property. So it is going to use its capital or perhaps some borrowed monies to buy this property. When that property is fixed up and ultimately sold, the profits flow back to the retirement account, not to you as an individual, because again, the retirement account is going on the deed saying that it is the owner of this asset. So you're not borrowing money from your retirement account. Your retirement account is making this investment, just as it can invest in mutual funds, stocks, privately held companies, whatever the case may be there. So in my mind, I really break down the acquisition really of any asset to three fundamental strategies. The first is the most common, where the retirement account is going to be the sole owner of, in this case, a house, and it's just simply going to pay cash to buy that house. So a very simple, straightforward transaction. The second concept is where the retirement account is going to joint venture or partner with other investors to buy a property. It could be partnering with an individual, it could be partnering with a retirement account, a company, whatever the case may be, it owns a portion of that house. And then the third option is where the retirement account is actually going to borrow some portion of the monies needed in order to be able to fund the acquisition of that property. What's really exciting for us is we're working very hard right now on kind of an exclusive relationship for our clients for this type of loan product. If a retirement account is borrowing money, it needs to be via a non-recourse lender. So essentially you are not personally guaranteeing the debt. It's what's called a asset-based loan. So if the deal goes south, the only thing the lender can do is simply take the asset back and foreclose, can't sue you, can't sue the retirement account. So again, we're working really hard on a relationship there. I'm hopeful in the next 30, 60 days, we might be able to actually put on the books some sort of joint presentation with some representative from that financial institution. Again, that would be really exciting for us. So please stay tuned to that. So now we're just going to run through a really basic example. We're going to call this individual Hustler Heather. She's someone that has a construction background. She understands the sticks and bricks of real estate. She's been doing house flipping and perhaps maybe she's done some new builds. So she understands the real estate investing game. And so now she's looking to take some of the money from an old 401k she has and grow that money via a strategy that she knows and understands, which is real estate. So Heather locates a property off market for 150K. Let's say she was driving a neighborhood and saw a for sale by owner sign. Heather's IRA is going to pay cash for that property, also use 10K. So just the lightest of light paint and carpet type cleanups, maybe not even paint and carpet these days, maybe running a vacuum through the house for 10,000. And then ultimately from sale to sale, it's going to take about 6 months. Now, the key is that any and all holding costs for the ownership of the property need to be paid for by Heather's IRA. So taxes, insurance, HOA, utilities, all that stuff is being paid by the retirement account. So excuse me, I didn't change the last figure here. A buyer comes along and purchases the property for 195K from Heather's IRA. You definitely don't want to buy for 150 and sell for 95 if you can help it. So again, apologies, my error there. So I think I got everything recalibrated here. So the way that this works from a flow of cost standpoint is, again, it's sold for 195. You're into the property for 161K. So whatever that net profit is, that flows back to the retirement account. So whether it's 30K, 3K, whatever the case may be, those profits will flow back to the retirement account. So again, apologies for the graphic error there on my part. Now, if you're looking for additional information, we do have a YouTube channel, The Lousy Investor. And so we put up fundamentally two different types of content on that channel. Some is purely really self-directed related, as this presentation was today. Others, I'll just kind of go through some very specific ideas around investments that I've made, mistakes that I've made in investing, strategies that I'm utilizing. And that's a way that we can just kind of share and be a part of the investing community. So again, kind of the hardcore investing part, and then also the self-directed part. And we break it down into a couple of different categories, if you will, on the Lousy Investor channel. So if you're a glutton for punishment and you're looking for some more information, definitely feel free to check that out. And feel free to contact us if you're interested in opening a self-directed account. We'd love to be a resource for you. So my email is Sean, SEAN, at AmericanIRA.com. And the phone number for the headquarters is 828-257-4949.